Hello and welcome to tradingfloor.com. Looking back at the currency markets in 2010, monetary policy from central banks has pretty much been the main attraction. From the Fed rolling out QE2 to the ECB's efforts to contain the sovereign debt crisis in Greece and Ireland, monetary policy from the central banks looks to be under the spotlight for 2011. So what can we expect to see in 2011, and how will monetary policy shape the FX market in 2011? With us, a special guest from Houston, Texas, FX consultant John J. Hardy. Welcome, John.
Thanks.
And so if we have a quick look at 2010, how could we describe it?
Quite a shift if we're talking about monetary policy from the major central banks. The G3 being Eurozone, the U.S. Fed, and of course the Bank of Japan. We went from talking at the beginning of the year about exit strategies, that is the idea that the economy was coming back fast enough that the banks were going to have to unravel some of these programs that were designed for the emergency days of the post-Lehman crisis of late 2008, early 2009. But quickly we saw that throughout the course of 2010 that the economy wasn't really reaching what you might call escape velocity. So we actually went from exit strategies to re-easing or easing again. Of course, it started with the Bank of Japan doing unsterilized currency interventions. We had the Bank of England never really pulling out of their asset purchase program. And then, of course, the Fed in late August was sort of signaling what was coming at Bernanke's speech at the Jackson Hole Conference in Wyoming. That was in late August, and then we saw the actual move in November. Heavily anticipated from perhaps late July, especially in August when he was sort of hinted that this was coming. And then, interestingly, post the actual decision, we've seen a backup in interest rates again, and we're sort of going into 2011 with this interesting tension. We've got overheating emerging markets with a different set of policy needs there. Some of that overheating possibly caused by excessive easing in the major central banks. The G3 banks, especially the Fed, of course, easy money, meaning that we go and speculate in the places where there's better yield, better growth. So that's the big question going into 2011 is how do the different regions of the global economy deal with their different needs that are often in conflict with one another.
So obviously global recovery is kind of like, I suppose, driving these moves. Is the recovery from an FX point of view heading in the right direction?
Well, from the FX point of view, what we're seeing now is sort of a momentum trade or a high-risk trade. In other words, the funds or the capital flows are going there where growth is greatest. So you've had some tremendous move in emerging market currencies. A currency like the Australian dollar has been a superstar for most of the year, well, especially since the summer when the anticipation of the Fed's move was coming because of the popularity of commodities. And that's where the flows are going right now. The question is, now that we've got commodity prices going higher and higher and interest rates also coming up, at what point does that become an actual danger on the fundamental side for growth? And do we hit sort of a brick wall in terms of overheating and then having to anticipate some kind of economic slowdown in the new year? Timing, I think, is very difficult. I think this could happen. Very difficult to say when. How far ahead of itself has risk appetite gotten? Can it go another few months? Is it way too far ahead of itself? So we may see sort of a split year. Maybe like we saw in 2010, where we saw a lot of worries and then this huge rally, and then we might see a similar kind of a dynamic, maybe starting with a rally and ending with sort of an uh-oh moment when we realize it's going to be a bit of a tougher slog than what markets are looking at now.
So over to monetary policies from the majors. What kind of role are we likely to see in 2011? Obviously, they were in the spotlight for 2010. Is this going to continue moving into 2011?
Yeah, the biggest question for us, or for everyone, is the Fed in 2011. Of course, they just launched this QE2, $600 billion of bond buying. What has it netted them? Well, interest rates have almost doubled at the area of the curve that they've been concentrating on buying bonds. Interesting reaction. Does this continue? Do rates go higher and higher? I think also there may be insufficient will or sort of political will to allow the Fed to continue to operate with the degree of freedom it has operated with, especially in the crisis days, but also as recently as the QE2 announcement. We're seeing a lot of sort of resistance to what the Fed has done, the whole bailout mentality, a very new Congress coming into office here in the U.S. So I think U.S. monetary policy-wise, first of all, does the growth come as hoped? And if not, is the Fed able to move with the kind of leeway that it was before, or does it find some kind of resistance from the Congress, possibly even from the president, if he senses that this could be an area where he might be losing popularity coming into the 2012 election season?
And if we take another dynamic that you mentioned just now, the emerging markets and these emerging economies, like for example Brazil, what role is a country like Brazil going to play in the FX markets?
Well, all the emerging markets are faced with a very tough set of circumstances now. They're seeing very heavy capital flows, sort of overwhelming sometimes in terms of the size of their economies. It's aggravating the currency strength there. It's driving up commodity prices because people are also investing in commodities. We're all worried about these central banks, big central banks, and they're devaluing their currency, so we have to own something that's a hard asset. And these hard assets are often produced and exported from emerging economies. Well, they're also used by emerging economies, and often their economies are very sort of resource intensive per unit of GDP. So I think what we risk actually is a dynamic where they may have to tighten policy, which is usually positive for their currencies because of the interest rate implications and so on. But if the anticipation becomes one of what does this mean for some kind of a hard landing for their economies as they're forced to reduce their consumption of commodities because of the price spike, that's the stress moment for emerging markets. How do they respond in terms of the rise in commodity prices with their policy? Do they start having even more extensive capital controls than the ones we've seen already from the likes of Korea, Brazil, which already has very overvalued currency, and so on? That's this tension we have between the emerging market central banks and the G3, G4, G5 even central banks.
So a very interesting 2011.
Lots of tension, lots of currency wars has been the term coined by the Brazilian finance minister, and I think we'll see plenty more tensions in 2011. Yeah.
Great. Well, thanks for your time, John.
Thank you.
And don't forget, you can actually follow John on Twitter at John J. Hardy, and you can also follow us on Twitter at tradingfloor.com, and don't forget to visit tradingfloor.com for the latest in insights on global markets. Thank you, and we'll see you next time.